Today, I want to talk about why Piedmont operates primarily on a post-tax basis. Right now, there are three major shifts occurring in the VB market that you must adapt to in order to survive in the future. Today, we will talk about the first of those three shifts, the shift from pre-tax to post-taxing of VB plans. This is because of IRS regulations that outline the taxability of the pre-tax policies or those that have employer-defined contribution. Any benefit payment in excess of unreimbursed medical expenses is now considered a taxable event to the policyholder and perhaps the employer. When do benefit payments exceed unreimbursed medical costs and supplemental insurance? Well, the answer is approximately 80% of the claims. Two common examples are wellness claims and first occurrence benefits. Most wellness benefits are in excess of doctor visit copays nowadays, and most first occurrence benefits exceed the amount of unreimbursed medical costs at time of claim. For example, they receive a $5,000 first occurrence benefit prior to incurring that much in out-of-pocket costs. A recent memo from one of the top 10 brokers in the country read as follows. Last year, the IRS issued a memorandum that changed the way we look at the taxability of fixed indemnity plans, such as critical illness, accident insurance, and hospital indemnity coverage. When these benefits are purchased with pre-tax dollars or purchased by an employer for its employees, such as defined contribution, for this reason, we recommend that employers offer these plans on a post-tax basis, or if premiums are paid for by employers, such as defined contribution, that wages are grossed up accordingly to eliminate the tax liability associated with offering these benefits. In addition, a market-leading carrier recently gave the following guidance. Quote, if the premiums are paid on a pre-tax basis through employer contributions or employee pre-tax salary reduction through a cafeteria plan, then whether the benefits are taxable depends on the individual's unreimbursed medical expenses. If the amount paid under the policy does not exceed the individual's unreimbursed medical expenses, then the amount received is not includable in the employee's income. However, if the amount received under the fixed indemnity policy is more than the individual's unreimbursed medical expenses, then the excess is taxable. Listen, they even gave a mathematical example to go along with that guidance. Quote, the plan pays $200 for a medical office visit. If the covered individual's unreimbursed medical expenses as a result of the visit were $30, then the $30 would be excluded from the employee's income, and the excess amount of $170 would be taxable. Think about that for a moment. Are you making sure your clients and policyholders are educated about the tax liability and possible consequences? What would happen if a competitor knocked on your client's door and provided this information to them? What would your answer be to your client as to why you kept them on pre-tax without educating them on the liabilities associated with it when it happens in the majority of claims? At Piedmont, our zero bill solutions are only used in a post-tax environment. So we not only eliminate the bill, but the tax liabilities associated with pre-tax plans as well. For this upcoming enrollment season, make sure your clients are aware of the risks associated with their pre-tax plans, or better yet, switch them over to a post-tax model before someone else does. To learn more, please contact us at Piedmont, and thank you for using Piedmont as always, the original payroll deduction alternative. Have a great week.